Let me go ahead and start the recording. There we go. Muy excelente. All right. Now, in today's series, in the PitView education series, we're going to be learning about the Gartley pattern. The Gartley pattern is an extremely powerful pattern in the market that I use myself. I think it's one of my favorite patterns that forms in the market. It has both high probability and also with a mixture of a naturally high risk-reward ratio in the market. You'll start to see kind of why I like the pattern so much. It gives us really good entries into specific currency pairs. When they're right, they tend to be very right and give you large profits. When they're wrong, they tend to give you small losses. When you combine it with PitView, it tends to be extremely powerful as far as being able to confirm your entries. There's a good chance, I should have named this specific subject matter today, Gartley Pattern Part 1, because my purpose here in today's class is to go over the actual pattern itself. And when we start class next Monday, we'll go into a little bit on Gartley Pattern Part 2. We'll cover the rest of it to where we bring in the specific indicators such as PitView on how to confirm it. Although I will touch on it today. For most of you, it'll make sense for existing PitView users. But it tends to take a little bit longer than 45 minutes to an hour to get a lot of these things done. So let me go ahead and get started. One of the most interesting things about the Gartley pattern is, just like anything else in technical analysis, it's highly subjective, because the Gartley pattern actually comes from a book that was written in 1935 by a guy named H.M. Gartley. Now, people that know me know that I'm a big history buff, so I always like to kind of go in the history of where things come from, and you get a better idea of how subjective some of these patterns can be in the market and how they've evolved over time. The Gartley pattern was written in 1935, and the interesting thing about this book by H.M. Gartley, in which this pattern came from, a book called Profits in the Stock Market, is that at the time the book was written, if you wanted to buy this book on trading, it would have cost you the equivalent to 3 Ford automobiles. I always find that extremely interesting, because if you think about things nowadays, if you wanted to buy a book on trading, could you imagine paying the equivalent of 3 Ford automobiles in which to buy it? I don't think so. So I always thought that was interesting, that if you wanted to buy this book on trading by Gartley, you would have had to pay a huge amount of money especially when you adjust for inflation for today's dollars, in order to get this book. Now, the interesting thing is that this book is huge. The Gartley pattern, the namesake of Gartley, the Gartley pattern itself, is only found on one page of this book, page 222. It takes up one page. And since then, it's evolved because really all it is what we call an impulse move with an A-B-C correction, whereas A and C are equal. But it's funny when you think about how popular this book was back in the day, but the only thing that's really stood the test of time, there's been several other things that have come out of this book, but the thing that Gartley's namesake is applied to only takes up one page in this long book. And it did not include Fibonacci ratios. One of the things that's really interesting about trading is the fact that when you get a bunch of technical analysts in the same room together, geometric analysts, pattern analysts, different people, different types of technicians that analyze different patterns in the market, is they always say, well, this is the right way to do things, this is the wrong way to do things. And most of the patterns that you see, Gartley right now is considered to be what we call a Fibonacci pattern. However, at the time the book was written, it did not include Fibonacci ratios. So the interesting point that I try to make on that is the fact that when people say, well, this is the right way to trade a Gartley, this is the wrong way to trade a Gartley, when I go back in time, if I were to get into a time machine, we were to go back and ask Gartley himself what the right and wrong way to trade a Gartley pattern would be, he would probably say, I don't know. I don't know what a Fibonacci is probably where he would go with that. There's what we call bullish Gartley and bearish Gartley. So these are things that can form at any time. They can be sporadic in the market sometimes, but these can be used in any time frame, essentially. Bullish Gartleys and bearish Gartleys, they've been happening more frequently in the market on the longer term time frames. One thing I do want to mention to you, though, is that since this is a pattern, the same rules to pattern trading still applies to the Gartley pattern. The main rule for pattern trading is the longer a pattern takes to develop, generally the stronger the pattern is. So even though the reason why I use this in our swing trading methodology of talking about swing trades on 1 hour, 4 hour daily charts is because generally speaking, those are the time frames in which I look for strong Gartley patterns. However, they can be used in any time frame. The thing about them also, when you look at the shape of what a Gartley is here at the bottom of the screen, and let me get my ink color out here real quick and choose my pen. Change my ink color, there we go. Is when you look at bullish Gartleys, what we're looking for is what we call an impulse move with an A, B, C correction, whereas you're buying as something is coming down in the immediate trend. And on a bearish Gartley, an impulse move, and don't worry, we're going to go through this in detail, with an ABC correction where you're selling in the midst of what the immediate trend would be bullish. A lot of people have a hard time, and I'm kind of getting into the psychology of Gartleys here. A lot of people have a hard time trading these types of Gartley patterns because of the fact that people often tell you in trading never try to catch a falling knife. When you, I'm not going to lie to you, when you buy or sell into a Gartley pattern, it takes some intestinal fortitude. PitView can certainly help with trading into these because it does allow you to know that you're getting along the right side of the market makers. However, it does still take some intestinal fortitude because when you're buying on one of these, you're looking at the chart and the chart is telling you that it's going down and you're buying as it's going down. You're trying to kind of pick a bottom. And when you're selling as it's coming up. So you're trying to sell a top. And people often tell you not to do that. The Gartley pattern is probably one of the only patterns that exists where I actually try to do that rather aggressively because it does seem to be very powerful when it does occur. And don't worry, I'm going to go into all those harmonics and everything that was just on the bottom of that screen. I just kind of like to give you a good idea of what you're getting into here is the fact that you're not, some people try to wait until they're 100% comfortable in what they're doing before they get into a trade. Gartley is certainly something that when I've taken trades on it before, especially when I first started trading them, there's almost a pit that forms in your stomach when you're buying it because it kind of goes against everything. It goes against that trade with the trend because the trend is your friend mentality that a lot of people have in the markets. Now, as far as the Gartley pattern goes, let's kind of quickly go through the good and the bad of them. There's always a point or pros and cons to every single type of trading in the market, which is what makes the market interesting. Nothing is 100%. The good is that it's a low risk, high reward pattern. Generally with my students, we always look for a minimum of what we call 1-to-1 risk reward, whereas we're risking the same amount on a trade that we're wanting to make back. The good thing about a Gartley pattern is that when you do get into a trade, the amount of pips that you're putting up for risk is very low in comparison to the amount of pips potential that you have for reward, for profit. And so when you get in on a Gartley pattern, they naturally give you a higher risk-reward ratio, which is all something that a lot of traders look for because the higher risk-reward ratio that you can get on a trade, the better your overall trading account's going to do whenever you compare your winners versus your losers, especially what we call your average winners versus your average losers. The probability on these has stood the test of time. I'm not quoting directly from Gartley, but when you look at the actual probabilities on a Gartley pattern, In his book, he said, 20% of the time when this opportunity presents itself, you tend to, and you lose. You tend to incur small losses, and 80% of the time you tend to incur large profits. So the naturally high risk reward ratio and the nice probability that goes into this pattern when it does develop still stands the test of time as a high probability pattern in the market. And it can be applied to any market and time frame, meaning this is not a Forex specific pattern. I know as many of you are Forex traders. This is not a Forex specific pattern. When these patterns form, these patterns have the same type of probability when you trade them in the stock market, futures market. They can be applied to any market, any time frame. Down from 1 minute charts, I've seen people trade Gartleys before, all the way up to weekly and monthly charts. I've seen people trade Gartleys. I will tell you, people always ask my personal preference, and as far as time frames go, this is just the charts. The charts that I generally do a lot of my swing trading off of are generally 1 hour charts. So that's generally where I start looking for my Gartley patterns. As I stated before, they are highly subjective. What this means is that the beautiful thing about technical analysis in general is everything's an opinion. You get a lot of opinions in the market and not a lot of facts because, as I said, we don't have a time machine to go ask Gartley, what the proper way to trade these things are with Fibonacci. So it can be highly subjective. You can get a group of Gartley traders in the same room and they may have multiple different styles as to how they trade them. And this is not, since this is more of a swing trading strategy and it's a pattern, patterns are not very predictable. What I mean by this is, if you go back in class to kind of the shorter term trading methods that we've looked at, you can kind of count on getting a buy or sell on a short term trading method with like an indicator each and every day. Gartley is not something that you can count on getting a trade on every day. For example, when I'm looking at the 1 hour charts, there have been times with my students, because I trade live with them every week, to where we'll get 3 or 4 Gartley patterns in a week, and then we might go an entire month without getting a single formation in a Gartley pattern develop. But it's always a great pattern to have in your toolbox, if you will, to be able to apply to your trading when they do occur. So now that we've kind of gone through and I've set you up with some of the good and bad and gone through a little bit of the psychology on a Gartley pattern, let me just kind of define it for you based on what we call a bullish Gartley. Gartley starts off with what we call an impulse move. Now, a lot of you may not know what an impulse move means or what it is. An impulse move is essentially a trending movement, a strong trending movement, a strong set of higher highs and higher lows that occur in the market. That would be considered what we call X, or an impulse move, as far as a Gartley pattern goes. And then what we look for is what we call an ABC correction. Now this is where the subjectivity comes in, to where you really have to, no two Gartleys are ever really going to look alike. Sometimes they will, but they can be hard to spot in the market. An ABC correction is once the market is making a series of higher highs and higher lows. An A would be once the market starts coming down and forming a series of lower highs and lower lows. And then a B is when that A corrects upon itself into a set of higher highs and higher lows. And then the C would be the market coming back down and breaking into another set of lower highs and lower lows. So this is just an impulse move with an A, B, C correction. Now the key thing about a Gartley, what makes a Gartley, is basically it's just an impulse move, which is your initial set of higher highs and higher lows. That breaks down to where the market breaks down into lower highs and lower lows, which is considered our A. That A breaks upon itself into higher highs and higher lows, your B, and then the market settles down and comes back down in the midst of that immediate trend into what we call a C, which are lower highs and lower lows. Now the formation itself, which is the impulse with the ABC correction, the key to a Gartley pattern, what makes it so objective, or subjective I should say, subjective, is as this ABC correction is hitting what we call the 78.6% Fibonacci retracement level, what you also need is you need the A and the C correction to be equal to one another. The subjectivity on that of what makes A and C equal is what the A and C being equal is what makes it a Gartley pattern. The impulse move, ABC correction, where A and C are equal. Whenever you talk about equal in the Forex market or any market, it's hard to define equal. Like, if A is, if A right here is 80 pips and the length of C is, let's say, 70 pips, is that equal? No. So it's hard. It's very subjective as far as what makes A and C equal. That's why we have what are called harmonics when it comes to Gartley pattern, that a set of rules, if you will, to where we're able to define whether the A and the C correction are equal. Now, most people that are going to trade this Gartley, they look for what's called a trigger line. In this case, a lot of people that use the Gartley pattern, and this is also something that can be subjective, will use this 78.6% level right here as what they call their trigger, or the trigger line being your entry line. Is once you have that ABC correction as it comes down and hits the 78.6 level, if you're able to define A and C as being equal and it being a valid Gartley pattern, the 78.6% level is what's called your trigger or your entry line. But again, I stress that when Gartley wrote his book, it didn't include Fibonacci's, so a lot of people, there's a lot of subjectivity. Some people might use a 61.8% Fibonacci ratio. Some people might just look for an ABC correction where they see when C becomes equal to A, they enter into the trade and not even use Fibonacci's. But for the purpose of this class, we have to have rules, and these are the rules that I use for the majority of my Gartley trades that I get into. So as you can see, when you're entering in at that 78.6, you are entering in when the market is coming straight down. It's extremely, or it can be extremely subjective, and it can be extremely painful to get into these things as it is coming down. And when I talk about painful, it's one of those things to where the market trend is doing one thing and you're looking at doing another. And it takes some intestinal fortitude, if you will. Here's an example of a bullish Gartley trade right in here. As you can see, we have what's called an impulse move right here, which we would consider X. It's just an extreme set of higher highs and higher lows that are being made in the market. And then what happens is that breaks down into what we call an A, an extreme set of lower highs and lower lows where that impulse move is correcting upon itself. That A corrects into a series of higher highs and higher lows, which is what we consider a B, and then that corrects down into a series of lower highs and lower lows again, which we would call a C. That would be an example of a bullish Gartley. And what your entry trigger for this would be right here at this, oh, I'm sorry, let me go back here. Your entry trigger for this would be right here at what we call the 78.6% retracement level. And don't worry, my class recently had a bullish Gartley actually last week that we traded together that I can show you that actually was that can kind of help you define this, which I'll show you live on the MetaTrader here in just a second. So the thing that makes this interesting when you really think about it is that when you have this type of formation that occurs in the market with the ABC correction and the 78.6 level, is that you're looking to be a buyer here. The cool thing about being a buyer down in here is the fact that if you were to take this chart out to anybody on the street and you were to say, okay, here's where we're trading right down in here, would you be a buyer or a seller here? Most people would look at this immediate trend that's coming down and they would say, you know what, I'd be a seller because I trade with the trend because the trend is my friend. Well, I would say 90% of the people would probably say to be a seller at this point down in here. But when this formation does occur in the market, you are actually looking to be a buyer as it's coming down in the immediate term, which it can be very much contrarian to what other people do. So that would be a bullish Gartley example, an example where we would be buyers. And I'm going to show you the rules that we look for to find when A and C are equal on this. This is an example of a bearish Gartley pattern where we have an impulse move called X, and again just an extreme set of lower highs and lower lows. And then we have an A, B, C correction. And we again are looking to be sellers here at this 78.6 level, because what we also have here is that even when you look at the arrows, you can see once it makes this series of higher highs and higher lows, when A forms, it creates a series of lower highs and lower lows, which is considered B, and then it continues on into that set of higher highs and higher lows and for C. And when you look at even the arrows, when you measure them, you can see that A and C look specific and very much equal to one another as far as the length. Very important that those A and C being equal, and that's defined as a Gartley pattern, before it hits your trigger line up here at the 78.6% retracement level. And again, you're looking to be a seller at this point, which oftentimes can be extremely uncomfortable for people because you are selling into an immediate trend that is actually up. But we're looking at the entire pattern itself of how it's forming in the market when we look at a Gartley pattern. Now, the thing is that a lot of people, when you look at these types of things, when you look at the market in general, Fibonacci patterns especially, whether it be Gartley patterns, there's also what we call three-drive patterns and butterfly patterns, ABCD patterns. Fibonacci patterns are perhaps probably the most difficult for a lot of people to spot in the market. So you need to be able to give them this kind of a set of black and white rules in which to follow that'll allow them to make better decisions and to be able to spot these things much easier in the market as they're occurring. And as I said, this is part one of the presentation. We're going to continue on with part two next Monday because it generally takes a little bit of time to explain this concept to people. So Gartley harmonics was actually something that was, if you've ever heard of a guy named Larry Pesavento, is somebody who brought in harmonics to the Gartley pattern, which combined the Gartley pattern, which is essentially the impulse move with the ABC correction, whereas A and C are equal. He combined it with Fibonacci levels in order to help us define and create a set of kind of black and white rules, if you will, that we can define what is and is not considered to be what we call a valid Gartley. So the Gartley harmonics look like this. When you are drawing your Fibonacci levels, and I'll go in and show you live on a chart what this looks like, there's a certain amount of rules that have to be met in order for it to be considered a valid harmonic Gartley pattern, if you will. So whenever you're getting your retracement, so once you know you've had an impulse move, that strong trending move in one direction or the other, and then you have that trending move breaking down in what we call an A correction, you need the end of A, the start of B, to have retraced to approximately or about, and a lot of people hate approximately or about, but oftentimes you don't get it exactly at the 61.8, so there is some subjectivity involved. The AB needs to retrace to about or approximately 61.8% of X, of that actual impulse move. The other rule for Gartley harmonics is that the end of B, the start of C, needs to have retraced to between 38.2 to 88.6% of the A correction on a Gartley. So once you get that A breakup into what we call a B retracement, the end of B has to have occurred at between these Fibonacci levels, between 38.2 to 88.6 of what we call A. And then, in order to get our trigger, once we have the start of C, or the end of C and the start of what we call D, it needs to retrace to 78.6% of X in order for it to be considered what we call a harmonic Gartley. So once that C starts coming down, and that's called the end of C, the start of D, because what you're trying to do is you're trying to trade the D correction in this, which if any of you know Elliott wave at all, Gartley patterns often can get you into the third wave of Elliott, which is considered to be the longest. I'm not a big Elliott wave trader, but it tends to be a part of that third wave of Elliott wave. So these are the actual, I would say, the closest thing you have to black and white rules on a Gartley pattern. But everything else can be rather subjective as far as, you know, looking at your A, looking at your B, looking at your C of what constitutes an extreme set of higher highs and lows, or even the ABC correction itself. Let me show you what this looks like on a chart, because most people are like, whoa, hold on a second. Let me take this bearish Gartley into account. This would be a sell opportunity in terms of Gartley. There we go. There we go. Okay. So what we do is when we're looking for Gartley patterns, essentially what we see happen first is we want to make sure that we connect our Fibonacci ratios. When you're connecting Fibonacci ratios for a strong trending move, in this case X, you are going to connect the high to the low of the impulse move itself. You connect the high to the low, and that's going to bring up your different Fibonacci levels, showing you as it retraces by certain percentages of what those Fibonacci ratios and levels are, Fibonacci retracement levels essentially. Now what we need is once we have once we see that the market is making, you know, we have an impulse move where it's coming down, and so we're connecting the high to the low. And once we see that this starts correcting upon itself, you see right in here, you see that that impulse move is starting to break apart. It's starting to make a series of higher highs and higher lows, and that's considered A. And what we need on that A, of course, is we need A to retrace to approximately 61.8% of X. Now you see the end of A right in here. You can see the end of the arrow right in here. When I say approximately or about, that's the subjective part. Not often are you going to get it making a perfect extreme bounce from the 61.8. But you just needed to bounce or find resistance in this case on a bearish Gartley at approximately 61.8% of X. From there, you need the B. When the B starts to retrace down, you see that A starts to break apart into a series of lower highs and lower lows. And B needs to retrace to between 38.2 and 88.6% of A. So when you're looking for Gartley harmonics, you would again draw when you see that the B is ending approximately right in here, you would again draw your Fibonacci retracements from the low to the high of A to ensure that this B, when it's ended, when you see it starting to come back up, you want the end of B to have ended between these two levels as far as Fibonacci retracements. And remember, these levels right in here, these aren't the levels of X. You want it to retrace between these levels on the B correction of A. Okay? And then once it starts making higher highs and higher lows, once these two rules have been met as far as a Gartley, and you see the market starting to come up, especially when it breaks through the end of A, you know you have a valid Gartley, and so you have a trigger. Once it hits the 78.6 level is what triggers your sell signal on the trade to go short and look for a downward move on a Gartley pattern. So the impulse move with the ABC correction is what you're looking for in this. Now, as far as the actual entry and exit methods, this is where some subjectivity can apply to it, because oftentimes you'll get Gartley patterns to where it might not hit the 78.6 level, your trigger line, but it might come really, really close. That's one of the reasons why I find the PitView to be so helpful, because the 78.6% retracement level in upon itself is actually a very strong support and resistance level in the market. It's kind of the market's last line of resistance or last line of support before something retraces 100% and breaks into what we would call a new trend or trend reversal, if you will. So the 78.6% level in upon itself tends to be a very strong support and resistance level in the market. When this pattern, when the Gartley pattern actually does form in the midst of that retracement, it just makes you more confident in taking a trade or a sell trade at that 78.6% retracement. Where PairView and PitView can come into play is as it's getting close, generally I'll start looking at my PairView. Like this is on a 1 hour chart. I'll start looking at the PairView on with the PitView indicator. Once it's broken the high of A over in here, once I know the first two conditions have been met, sometimes it'll come really close to the 78.6 but not hit it and then make a strong move down, because that 78.6 level tends to act as a really strong springboard in the market where prices can tend to violently bounce off of them. So it's one of the things that I'll use the PairView for, and I'll probably talk more about the PitView of ways to trade this with actual PitView coming up next Monday and at the end of class today, of course, but probably won't have a time to get into everything when it comes to how to trade with this with PairView, because of the fact that it can be very subjective and it's kind of a feel type of thing that you have to look at. You have to be in front of your computer to find it. So as far as A and C being equal, you can trust the harmonics. When you have those harmonics in place, when you know that A is retraced to approximately 61.8% of X, when you know that B has retraced between the 38.2 and 88.6 of A, and you see that C has come up to the 78.6 level, that is about as black and white as it gets as far as rules for a Gartley pattern. Some people that are really experienced in technical analysis, they'll just eyeball it. When they see the market make an impulse move and then correct upon itself into an ABC correction, I've known people in the past that won't even use Fibonacci levels. They'll just see that the ABC has happened. They'll see that A and C look equal to one another on the chart, and they'll just go ahead and take a buy or a sell signal off of it. So eyeballing it also. Some people will also go in and measure, this is another subjective part of it, to where they'll measure the length of the A, B, C correction, to whereas essentially they'll measure the A correction, meaning the initial set, the initial correction of A, and they'll measure the C correction to the trigger line, or what we call the projection of C if it has not hit the 78.6. And as long as they're within what we call 75% of one another, that would be also considered to be equal. And this percentage can change from trader to trader, if you will. This is another thing that I'll go a little bit further on next week. I'll show it to you real quick, but it's another thing that can often get people really confused. A lot of people just would rather trust the harmonics, if you will, of the Gartley pattern because, again, you know, what makes the Gartley special is when that A and C are equal to one another. So in this case, when we look at this same bearish Gartley on the dollar yen, we see that the A correction, when you measure from the start of A to the end of A, where it finally found resistance and broke into a B, you would see that it was 81.4 pips if you were to measure it on a chart. Once you see once you see B start to break apart into higher highs and higher lows, you can actually measure from the start of C to the actual 78.6% level, even if it hasn't hit it yet. Let's say the market is still below that level. You can actually measure it out to the 78.6 level. And you see that the projection of C on this would be 75.5 pips. So what I do is, whichever number is larger, if the A is 81.4 and the C is 75.5, whichever of these two numbers is larger as far as pips, I'll just take the larger amount, in this case the 81.4. I'll take 75% of that, and as long as the C projection in this case falls at or above this number, 61.1 pips, I would consider it to be equal, A and C to be equal to one another. Now some of you are looking at this and it's making you go cross-eyed. You're like, wow, this is a lot of stuff to take into account on a trade. I always look at things, I'm pretty much a simpleton. This is about as complicated as I get in trading. Most of my stuff is really, really, really simple as far as how I look at the market. This is about as complex as it gets as far as looking at these A and C corrections. Some people consider it tea leaves, but when you see the power of this pattern and how it can help you, it's extremely, extremely powerful when it does occur. Does it work 100% of the time? No, nothing does. Those seeking perfection in the market, you're going to be in for a long journey, trying to make good trades in an imperfect trading world. All right, so the action here, generally speaking, when you know that you have a valid Gartley, when the harmonics are met, or when you see that the A, B, C, and the A and the C are equal in the correction itself, once it hits the 78.6 level in this case, the entry can be highly subjective also. You know, once it hits 78.6 or the trigger line, even before, if you're using PitView, can get you into these trades before it hits the 78.6 level, because oftentimes it will, like I said, dramatically spike off of that. You can enter anywhere between the 78.6 and 100% retracement level, meaning this is called what we call a trigger zone on the Gartley. A Gartley is still valid as long as it has not broken into a new high in this case. This is a bearish Gartley. Remember, we're looking to be sellers in here. I'll show you a live example of a bullish Gartley here in just a second. So we're looking to be sellers in here. This is a bearish Gartley. A Gartley, whenever you're looking at it, if you see that one's formed on the chart, and let's say it's trading right up in here between the 78.6 and the 100%, you still have an entry. It's still a valid Gartley. The only thing that invalidates a Gartley is if it breaks the 100% retracement, if it breaks into a new high, if you will. That's the only thing that no longer makes it a valid Gartley pattern. So once you know you have a valid Gartley, you can enter really anywhere within this zone right in here, and even a little bit below the 78.6 if you're using PitView. It can sometimes get you in a little bit earlier and allow you to be a bigger part of the move down when these things do occur, which I'll go into here in just a second. So that's the beautiful thing about Gartleys is a lot of people will look at trading like trading patterns sometimes, and they'll think, well, I'm too late. In this case, you're not really too late on a Gartley. If you spot it, and as long as it's still valid, you can oftentimes still have a valid sell signal on a bearish Gartley or a valid buy signal on a bullish Gartley, as long as it's really close to the entry zone. Some people might use what's called a touch and close when they look for confirmation, like they'll wait for it to touch the 78.6 and then close below it as kind of a confirmation of a bounce. You can do that also. The stop on a Gartley is always we always place our stops where we're wrong. So obviously we're sellers. You know, the trigger line for this is the 78.6 level, and it could be even below that if you're trading with PitView, as long as you see PitView start to turn. But the thing about this is, if we're looking for this to head down after we sell it, people are always going to ask, well, for sellers at this price, where do we place our stop? Well, we place our stop where we're wrong. So our stop is going to be at least, I always put a minimum, at least 1 pip outside the 100% retracement level, the start of the actual impulse move itself. Okay, the start of this impulse move, because if it breaks the 100% retracement, it's broken into a new high. The Gartley is no longer valid, so that's your potential area there where you'd want to place your stop order. Now, the great thing about this is the fact that when you look from your entry to your stop order, this is your risk on this trade. So if you're wrong and you do get stopped out, the amount of pips that you risk is very low, low risk, to where if you are correct, and this is a great continuation pattern for trends. If you've ever heard the term buying or selling a dip in the market, you know how a lot of analysts in the stock market and other markets will say, well, this is a really strong trend. I'm going to look to buy dips. In an uptrend, a dip is when the market's making higher highs and higher lows, people are trying to buy into the higher lows as they're being made in the market. That's buying a dip. Selling a dip in the market is when the market's making lower highs and lower lows, of selling into the lower highs, if you will, as the market is coming back and retracing, because markets never go straight up or straight down. So if this does continue on into trend, what you start to see is that if you're wrong, you're going to lose a smaller amount of pips. If you're right on the trade, your pip potential as far as your risk reward is actually very high. It's very cool when you think about it. So that's where the natural high risk reward ratio comes in, because you're risking this amount to potentially make this amount on the trade, as we experienced this week in my class, or this past week in my class. Now, as far as entry methods at the 78.6 level, you can enter when it touches the 78.6. Oftentimes, as the market is coming up near when I know I have a valid Gartley pattern, when it's approaching the 78.6 level, if I have a very strong Gartley pattern, I'll go ahead and put in a buy or a sell at the 78.6 level. Meaning right when it touches, I'm going to be in. And that's a very aggressive way to trade it, because that's probably the only thing that I'll use in the market to where I don't look for any type of confirmation. The only thing I've been using lately to look for confirmation is there's been Gartleys that have happened as of late that actually will form Gartleys and not hit the 78.6 level, so they won't hit my actual entry point, but they'll make moves just several pips away from it. And so what I've been using as of late has been the PitView totals. Now, as far as the common time frames in which I look for Gartley patterns, 5 and 15-minute charts, 1 and 4-hour charts, and then I also look for them on 8-hour and daily charts quite often, is I'll use the PitView for when things are approaching the 78.6 level, and this is something that can be subjective, and that's the beautiful thing about PitView, is that you are trading along with the market makers when these things occur. Is if it's a short-term Gartley, like if it's an intraday Gartley on a 5 or a 15-minute chart, I'll look for the PitView totals on the pairs that I'm trading. Is when I know a valid Gartley has presented itself, as it's approaching the 78.6 level, I'll wait for PitView totals to either go to a plus 20 or minus 20 on the buy and sell imbalances. And oftentimes what that will do is that'll confirm an earlier entry for me. There have been a lot of times where we've gotten Gartley patterns that have not touched the 78.6 level, yet they've been, as far as the subjectivity, they've been close enough to where most traders would get into them, including myself. Oftentimes you'll start to see large buy and sell imbalances occur at those levels. So if I'm looking at Gartleys on 5 or 15-minute charts, which is not as common for me, if I see the imbalance turn to a plus 20 or minus 20 in the direction of where the Gartley trade should go, I'll go ahead and get in, and oftentimes it'll get me earlier in on the trade. On the 1 and 4-hour charts, the imbalances, as you look at longer time frames in the market, because you're looking at more data coming from the market makers, on the 1 and 4-hour charts, if I see a plus 5 or minus 5 in the PitView totals, in the total screen, not the leaders and followers, but on the total screen, that oftentimes also will give me a better entry trigger into my trades. So even if it hasn't touched the 78.6 level, if I know I have what appears to be a valid Gartley, if it's getting close to the 78.6 and I see the PitView totals on the 1 and 4-hour, this is what I use quite a bit, change to plus 5, which would be green on a bullish Gartley pattern, or minus 5, which would be red on a bearish Gartley pattern. And remember, we're looking at the total section of all the market makers, 100% of the activity. That's another thing that I'll look at. Or if I'm looking at the 8-hour or the daily charts on PitView, the 24-hour periods, I'll look for the PitView to either go green or red, and oftentimes that can get me in to the trade much earlier, if you will. Now, before I go in and show you live what this looks like, let me just kind of go through. Exit methods for this for one thing, you go from more conservative to more aggressive types of exit methods when it comes to a Gartley pattern. The minimum that we always look for in trading is we always look for a minimum of 1-to-1 risk reward. The entry methods, I'll show you what that looks like here in a second on the live charts. But the exit methods, a minimum of 1-to-1 risk reward is what we always look for. That would be considered to be highly conservative when it comes to Gartley trading. If you're looking to make back, exactly what you're risking on a trade, it puts you in a high profitability scenario as far as the probabilities go. We always call it high probability of profitability. But it's conservative because the Gartley pattern in upon itself, since it does take so much intestinal fortitude to get in on these, it can be very much conservative because it has that naturally higher risk-reward scenario to it. Multiple lots is another term for scaling out on a trade. A lot of my traders, for example, will use multiple lots. What that means is if they're taking on a position of, let's say, 4 mini lots or 4 standard lots or 4 micro lots on a Gartley trade, what they'll wait for is they'll hit a 1-to-1 risk reward, and let's say they're doing 4 mini lots. They'll take off half their position, capture that 1-to-1 risk reward ratio, and then look for higher profitability on the other half of their position. So that's called scaling out. The Gartley pattern is actually one pattern that is almost made for scaling out. Higher risk reward does exist, so some people might get into their full position and like 4 mini lots in this example, and instead of looking for 1-to-1, they'll look for a 1-to-2 risk reward or 1-to-3 risk reward. So they'll just use the risk reward ratios themselves. And on a lot of Gartleys, you can get up to 1-to-4 risk reward ratio is certainly within reach when trading with the Gartley pattern. 78.6% retracement of what we call the retracement of the Gartley pattern. That's another exit method for trading this, which I'll show you here in just a second. This is called meat trading, if you will, of just trading the meat or the pass-through of the movement. And again, I'll review this again. Let me first, here, I'm going to pause my screen real quick. There's something I want to show you, but I need to take my screen off. I need to bring up my MetaTrader. There we go. Oh, I need to replay my, okay, here we go. Let me go ahead and pull up my notepad too. I'll show you what this looks like. I've got my MetaTrader platform up, and I'll show you an example of a bullish Gartley trade here. And I'll zoom in on it. What we were looking for in a class this week is we were looking for buying dollar yen opportunities to, or this past week I should say, I keep on forgetting it's a holiday week. We were looking for opportunities to buy dollar yen. We were looking for opportunities to buy dollar Swiss. And last Thursday, the trade I gave out to my morning students was this one right in here. See, an impulse move is essentially when you're looking at, higher highs, higher lows, and then it breaks into a, it breaks in and kind of reverses off this double top right in here. So I would call this a swing low, and I would certainly call this up in here a swing high in the market. So that's what we call an impulse move. The great thing about this impulse move, by the way, is if you were to look at something like a 4-hour chart, this impulse move goes right along with the the series of the sets of higher highs and higher lows on the longer time frames, the 4-hour and the daily chart. So trading Gartleys off of what we call a continuation basis can often be a really good idea, because when you're getting on them when the signal is giving you a continuation of the overall trend, of the longer term trend, that's when they tend to have the highest probability. In this case, looking to buy dollar yen. So here was our swing low, and here was our swing high right in here. Now you see it starts coming down and making a series of lower highs and lower lows. Now this is where it gets subjective. Is initially we were looking at this as being a potential Gartley, but we saw that it came down, and here's the 61.8. All I did is I went to the Fibonacci's right up here, the Fibonacci retracements, and I connected the low to the high of this impulse move. Now we look at this. Here's a lower low, lower high, lower low right in here. So I'm looking at all of this as being an A correction right in here. And this is where the subjectivity comes in. But what we also see here is you see that it found really strong support right here at the 61.8% retracement level of X, right? So we'll call this X over here. So this is X, this is the impulse move. And here's A. This is our A correction. And remember, what we need is for A, when it's making a series of lower highs and lower lows, we need that A to have ended at approximately 61.8%. And this is 61.8 line right in here of X, which you can see it does. Now what made this interesting was the fact that it did come right back up, and you see that it even broke a trend line in through here. You know, 1, 2, 3 points in a trend of lower highs in here, and it came up and formed a B, you know, set as higher highs and higher lows, which we would consider to be a B. You can kind of see where the subjectivity comes into play on these, because everybody might see something different. Now for B, we need this B to have retraced. You see how the end of B, the high of B is right in here as it starts to come down. Now, when we were tracking this, by the way, we were tracking it from, we saw that this had a series of lower highs and lower lows come down to the 61.8% level. So when we were tracking this, and then we saw it start to make higher highs and higher lows as far as the B goes. So we were like, okay, so that we now have a B coming up, and we saw B start to stall out. When you look at where the high of B is, the other rule for a harmonic Gartley, remember, has to be that this B has to retrace between 38.2 and 88.6% of A over here. So if I connect, I'm gonna go to my Fibonacci retracements again. If I connect the high to the low of A, you see that this B comes down, and you see the retracement. This is the 78.6% retracement of A right here. You see that B ends at 78.6% of A, which that fits into our Gartley harmonics, correct? So that means that that at this point we have a valid Gartley pattern, if you will. Oops, I erased both my Fibonacci lines. So that checks out right there. The B does hit and ends right here between 38.2 and 88.6% of A. Okay? So you can, if you wanted to, you can even draw a little line here. Now B retraces. This retracement is 78.6%. If I wanted to draw it like the websites do it. And then we have a C starting to come down in here. We know that A retraced to 61.8% of X. We know that B has retraced to 78.6% of A. That meets our second black and white rules as far as the Gartley pattern. And then we see it coming down here, and we see it start to make a C. We see it start to make a C correction right down in here. And there's our C. Now, what I'll generally look for is when you see that you have, we have a series of lower highs, lower lows, higher lows in the B, then another set of lower highs and lower lows here on the C. When you see it start to come down and make a C correction, when it hits below the low, you see here's what I consider to be the low of A right here. Once it breaks through this level, oftentimes what I would do before I had PitView is I would go ahead and put in a buy entry at the 78.6 level right here. And as it came down on the 1 hour charts, is I would go ahead and have a buy limit already set. Once it broke this low over here, I'd already have a buy limit set up to buy at the 78.6 level and put my stop. Of course, the stop is always going to be at least 1 pip below the 100% retracement. Now with using PitView, what you can also look for is on the 1 hour pair view screen, and here I'll pull it up for the yen real quick. I have my PitView up here. I'll go ahead and put this up here, and sometimes I'll just put it up here on the top of my screen so it doesn't bother me too much. And what I look for on the dollar yen is I look at this total screen right in here. Now obviously the dollar yen's been moving. This is not where the dollar yen was at this point. But what I'll often wait for now is I'll wait for this the total column on the 1 hour totals for dollar yen on the pair view. I'll wait for it to go to a +5. If I'm getting a bullish Gartley pattern, remember we're looking to be buyers, I'll wait for this to go to a +5. Now the beautiful thing is that when you wait for it the market makers to turn in the direction of this trend, oftentimes you can either get in early on the trade, like before it hits the 78.6, because oftentimes it'll come down and get close to the 78.6, like within several pips, and not hit your buy entry, and then come straight back up like a springboard off of it. But oftentimes what it will also do is give you even better entries. For example, on this one, it didn't hit a +5 until right in here. Before this big green move happened, because when I'm able to watch the screen, I won't have an entry order in. I'll just have the PitView up. On this red candle right down in here, it went to a +5, which actually got me in at a higher risk-reward ratio. Remember, I can enter into this trade anywhere between the 78.6 level and the 100% retracement level. When I'm able to watch the pair view screen on the 1 hour totals, and if I'm waiting for it to go to a +5 in the totals would look like, you see LP23 right here, how it has a +5.87 positive. That's a buy imbalance of 5.87. That's what a +5 would look like. Right now, today, it's at a -11, so that's showing more of a sell imbalance. I'll look at today what's happening here in just a second. But you wait for this total with 100% of the market makers to go to a +5. The beautiful thing about this is instead of entering at 103.654 at the actual Fibonacci level, I was actually able to get in 10 pips lower, because all through here it was showing red on PitView, and before this big green candle occurred right in here, PitView, one thing you have to know about it is it acts as a leading indicator in a lot of circumstances when you see buy and sell imbalances change with the market makers. This is on a 1 hour chart, yes. So it actually gave me a better entry at 103.5, let's see, 103.552. So the buy entry with the pair view occurred, waiting for the +5, occurred at 103. 103 point, it was 552. The stop on this, remember, the buy entry is right when it hits the 78.6 level. If you're looking for the actual trigger on the chart itself, you would enter right when it hits the 78.6 level. Either way, it would have been a profitable trade, okay? The stop you would place 1 pip below this low down in here. So that's 103.481. The risk on this trade, even though it was off the 1 hour charts, the risk on this trade was only like 7.1 pips. And your actual entry methods for this, you could have been either buy entry with PitView, or you could have put it in as a buy entry, as a buy limit at the 78.6% retracement. In that case, you would have gotten it at 103.654. So in that case, the risk would have been a little bit more. So the risk with PitView was 7.1 pips. There's no bad ways to get into these trades, by the way. And in this case, it was 17.3 pips. So oftentimes you'll get some better entries with PitView that give you even better risk-reward ratio. Now the thing is, when you're looking at this from a buy standpoint, where do we take profits? Well, in this case, let me show you kind of some different scenarios for taking profits on this trade. So there, all of our entry levels were right in this area, right in here. There's no real bad entries for this. It's just that, you know, I always like to show the benefits of what PitView does for you, because I know most of you are subscribers to PitView. So, you know, it's very powerful in getting you better entries into the market. So this entire zone down in here, there was no bad entries into this, okay? But our buy point was right down in here. You can see it's a little disconcerting to get in on these trades because you're trying to catch the falling knife as it comes down. So looking at this, where do you take profits? There's a couple of options that you have for taking profits. The first one that I usually have is if I connect the high to the low of the entire move down here, okay, of the entire Gartley pattern itself. I know I have a lot of things drawn on this chart, so just try to follow me. If I connect the high to the low of this move itself, you see how it gives me this 78.6% retracement here? This is called meat trading because the 78.6% retracement of the Gartley itself right here is at 104.110. That means you could have either risked 7.1 pips or 17.3 pips, depending on what your entry was. And this is a great way to trade what we call the meat of the movement. So your profit with the 78.6% entry would have been risking 17.3 pips to make $45.6. Your profit with PitView, you would have risked 7.1 pips to make you would have had the same limit, $55.8. Now look at the risk-reward ratios in there as far as what you're risking. Either way that you look at this, you are not going to be upset with this type of risk-reward ratio. This is the great thing about the Gartley pattern, is that when you're right, You're risking a smaller amount to make potentially a larger amount. And this is without, let me kind of explain this to you. I know I'm going over time here, but I tend to talk a lot, so I apologize for that. I tend to be a talker. When you only have an hour to explain something as complex as a Gartley pattern, you see why we need kind of a part 2 coming up on Monday, which we will do. So when you look at the risk reward itself, risking 7.1 pips to make 55.8, or even risking 17.3 to make 45.6 is what the powerful nature of the Gartley pattern is. Now, many of you are probably asking, why did you use the 78.6% of the Gartley pattern? What I like to do is I like to be a meat trader. What that means is, meat trading means this. Okay, let me connect the low to the high to show you where all these retracements are. And let me go in and I'm going to draw some support and resistance levels at our 2 profit taking levels, and so we don't have as much noise on here. I'm just going to go in and I'm going to take off these fib levels. Here's what meat trading means. Here's the 78.6 level for our entry, and here's the 78.6 level for our take profit. And let me also, I'll draw another line at the top, another line at our bottom. This might look a little bit like our pass-through levels, right, that we were talking about the other day. You see, here's the high and the low of all the moves. And what meat trading is that we're not looking for this to break up into a new high. This all gives us a high probability scenario for risk reward. We're not looking for this to break into a new high. We're not looking for this to break into a new low. If you look at this as like a hamburger, here's the top part of the bun, here's the bottom part of the bun, and then you see the pickles and tomatoes right in the middle, my green and red candlesticks in here. So I'm not looking for this to break into a new high to reach my profit-taking levels or break into a new low. That's where my stop is. I'm just looking to trade the meat of the movement in the middle, the meat part of the movement in the middle part. And that's what meat trading is. And that's all in terms of, here we have our Gartley pattern, our impulse move with our ABC correction, meets our harmonic parameters. We have our 2 different buy entries down in here. We're not looking for the market to strain itself to reach our take profit levels. This is our take profit level right here at this check mark. Okay, just looking to trade the meat of the movement. That's one of the most popular ways if you're just going to do an all or nothing trade, is to just look for that straight up take profit of the 78.6, and that way you're just trading the middle part of the movement. You can also call it trading the pass-through levels, if you will. Your other options that a lot of my students might do is, let's just take the example with my buy entry with the pair view at 103.552. Other options would be scaling out. I'm going way too long here. Scaling out, where instead of having 1 take profit level, you might have 2. So what you might do here is look for your risk here is 7.1 pips. So your limit 1 might be, okay, for my first limit, I'm going to look for a 1-to-1 risk reward, which would actually be, let's say if we're doing, just 2 mini lots. So limit 1, we would take it off at a 1-to-1 risk reward. And then limit 2, we can use the 78.6% retracement. So what we would do is move stop to break even. This is a nice little way to trade Gartleys too, is scaling out. You have your buy entry to where you get in. You take off half your position once you reach a 1-to-1 risk reward so that you can take some profits off the table. So sell one lot at limit 1, which would be for a 1-to-1. So once we make 7.1 pips back, because 1-to-1 risk reward always gives us the highest probability of profitability, and then move stop to your break-even point to lock in that profit, and then look for the larger amount of profit on limit 2. What that does is it eases a lot of fear for people. It eases a lot of the fear for people on these types of methods, because it allows them to take some profit off the table, ease a little bit of the fear, because that's what a lot of people do, is they fear not being able to reach or take any profits off the table. It also erases the risk on the trade, to where your worst case scenario, if you were to do this, would be zero, a profit of 7.1 pips, and allows them to let the trade run. So that's your other option on here, is just putting in a 78.6% retracement. I'll go through a brief introduction. So you're my intermediate students in this class. I'll go through a brief second part of this next Monday as far as the Gartley. I know I've gone overboard. You can see where it's at now on the dollar-yen. It's right now it's near those highs at that 104 level, right near that resistance level, and it's starting to back off a bit. You could even look at this as, if you're looking to short dollar-yen, you could things that we've already talked about, pass-through levels, lonely bar methods. You had two, lonely bar, looking for it to break through the trend line throughout here. These are all things that we've gone through in the past couple of weeks, but I hope I've been helpful in kind of showing you, how these things work as far as the patterns go. There's a lot of ways to look at Gartley. It's an extremely powerful pattern in the market. If I'm going to show you a winner, I can also show you one that was, let's see here. Here's one that got traded off like a 5-minute chart off one of my students. This was a little bit of a Gartley here, where you had an impulse move, an A, a slight little B. It wasn't perfect, and then a C that came down. This one would have stopped one of my students out. One of my students got stopped out on this one the other day. But that wasn't a very nice Gartley because the B didn't come up enough. Anyway, I'm wasting a lot of time here. I can go through all of this and review it next Monday when we meet as a class, because I got to go because I'm actually on vacation right now. So I'm going to go ahead and stop the recording here. I'll bring my PowerPoint slide back up.